This program is brought to you by Emory University.
I'm going to talk about the financial crisis. Not a pleasant topic, and also a topic that I was kind of hoping after 5 or 6 years of talking about the financial crisis I wouldn't have to talk about it anymore, but it doesn't seem to be the case. So it's not only not a pleasant topic, but I'm going to end rather pessimistically, so anybody who doesn't want to get depressed is free to leave now. I mean, it's unfortunate that that's the case, but I'll explain why that's the case at the end. So I want to start with what happened. I'm going to talk about what happened. And I'm going to explain why it was very hard for anyone to understand what happened unless you had several pieces of apparatus. You've been studying financial crises for 30 years, like me, and then you happen to be on a trading floor in these markets when it happened. So, and I'm going to, in a few minutes, I'm going to try to raise the level of the discussion about the financial crisis above what I see as the conversation out there, which is not very good. I'll also talk about what is a financial crisis, and I'm going to spend some time, quite a bit of time, on talking about whether crises have a common underlying structural feature or whether each one is some kind of series of special, unfortunate coincidences. Okay, so let's start. So a financial crisis is not just a bad event. Okay, it's not a stock market crash is not a financial crisis. S&L crisis was not a financial crisis. A financial crisis is a situation where households, or in the recent one, firms, don't believe that short-term bank debt is really backed with enough stuff, and they want all their money back. So everybody goes to the bank at the same time, and the banks don't have the money. Franklin Roosevelt explained this very, very clearly in his first radio address in March 1933. You can hear it on the internet. It's fantastic. What he said was, look, when you put your money in a bank, they don't just put it in a vault, they lend it out. So if everybody goes to the bank and asks for their money, they're not going to have it. That's exactly what happened in 2007, 2008. So this, as I'll explain, is a sudden, but it's not an irrational event. But the whole banking system just doesn't have the cash. They can't come up with the cash, so they can't honor their debt contracts, and consequently the whole banking system is insolvent. Okay, so we've seen this many times. So this is what it looks like in the old days. So before deposit insurance, Americans were very familiar with this. The 19th century, this is an event that occurred repeatedly. Everybody's at their bank trying to get their money out. And 1934, the American people just got sick of this, and they demanded deposit insurance. So economists were all opposed to deposit insurance, right? And so was FDR originally. Economists said, oh, there'll be moral hazard, and it passed anyway, and we got this long period of quiet. So let me now start with what you have to explain if you want to explain the financial crisis. The first thing is you have to explain how a small shock generated a giant event. So the realized losses, which as of 6 months ago are 20 basis points. 100 basis points is 1%. So 20 basis points is 20% of that. 1.9 trillion of AAA subprime securities issued in these years. That's how much money has been lost. In a typical securitization, and I'll explain what that is in a few minutes, 85% of it is AAA. The amount of AAA that was lost is just minuscule. It's minuscule, right? So it's not the impression you would get from reading, the business press. So somehow you have to get from that to Bernanke's statement that of the 13 largest financial institutions, 12 were bankrupt, going to go bankrupt. This is just after Lehman. So you somehow have to link these two things, okay? Another thing you have to do, you have to explain why the spreads on all assets rose. So spreads rise mean prices fall. So prices plummeted on everything, not just subprime. So if it's all to do with subprime or some kind of toxic asset story, you need to explain whether everything out there was somehow a toxic asset. So let me be a little more specific about that. So here's a picture. We don't need a lot of the details on this. Going up is bad. Going up is bad, right? Spreads are going up, means prices are going down. So the thing you want to have in your mind is going up is bad. So the red line is something linked to subprime. It's a derivative linked to subprime. That's all we need to know for today. So you can see that starting in January 2007, you can't see it because of the scale of the figure, but this line just starts going up. Right? Subprime starts deteriorating. We all knew that was going to happen, and indeed it happened. The blue line is a measure of interbank risk. That's all you need to know. It's a measure of interbank risk. Now you can see here that right here is when I had a heart attack, basically, and this was just kind of unheard of. And then it flattened out, and we get to Lehman Brothers. Okay. Now the thing to notice about this picture is that this line just goes up, but this line stays flat for a long period of time. So if the whole story was about subprime, it seems like those two lines should be correlated or close to each other. And indeed they are here. So this picture has the same measure of interbank risk, but it has three other spreads. And these are spreads on AAA securitized bonds backed by student loans, credit cards, and auto loans. So these are asset classes that have never had a loss in the entire history of the universe, and they haven't had a loss now, and yet they're tracking that interbank measure of risk very, very closely. So it's a bit of a problem, right? This thing, subprime, is supposed to have something to do with interbank risk, and that's supposed to be the whole story, but there wasn't that many losses on subprime. So we have this strange situation where you have this tracking interbank risk, but not that. Okay? Now, there's another problem here, which is that, people who try to explain the crisis, whether they're academics or regulators or the press or whoever they are, they don't have this data. Right? They didn't see this data, right? Because they weren't in a position to see the data. And that's going to be quite insidious. Okay, so we have to explain that. There's one third thing you have to explain. You have to say whether the crisis was this special event, right? It was immoral, greedy bankers created toxic assets, which they got inflated ratings and sold to stupid investors, right? So the question is that's not an explanation for every financial crisis. It's not even an explanation for this financial crisis. But you have to have a view about whether there's some structural reason why bank debt is particularly vulnerable to bank runs, or whether every financial crisis is some kind of special event. So, in fact, crises are not that rare, right? I mean, especially compared to what economists thought before this crisis. So since 1970, there have been 147 systemic events around the world, events where the banking systems were about to go bankrupt were it not for government intervention. And these events are not just in an earlier era. This is since 1970. Of these events, 147 involved bank runs, and in the rest of them, the government took some big step, like nationalizing the banking system or issuing a blanket guarantee. So here's just a list, just to convince you that developed countries haven't been immune from this. This is from some other researchers. So the idea that financial crises are rare is not true. The real question about the financial crisis is, why didn't we have a financial crisis between 1934 and 2007? That's a question we should all ask, right? Why didn't we have one? What, did bankers suddenly become greedy? But rating agencies suddenly got it wrong? So there's some sort of puzzle here to be answered. Here it is around the world. It's the same 147 banking crises, and you can see that the experience internationally is quite heterogeneous. You have some countries that haven't had a financial crisis since 1970. Sudan is one. They don't have any banks. That's a policy some politicians have recommended here. And you can see the all-time king of banking crises, the country that has a banking crisis like every 7 years, which is Argentina. So there's a huge range of outcomes. So they all look like this. So if we had lived in the 19th century in the US, we would be lined up at the bank with our friends, and we would all know what had happened. We wouldn't understand necessarily how this happened or why this was happening or what the effects were, but at least we would have seen this happen. So what I want to do is start with some banking history. And I want to start with some banking history just to alert you to some basic facts about these previous crises and to get you to start thinking about this in a certain way. So banking panics have been the norm. I'm just going to talk about the U.S. So as we've talked in this conference the past few days, before the Civil War in the U.S., banks issued their own money. Banks issued their own money. So I would have arrived in Atlanta with money printed by a bank in New Haven, Connecticut. And I would come here and I would try to buy lunch, and I'd have to stand there for 20 minutes while they were trying to figure out whether it was real and what it was really worth, and it was very difficult to actually transact. But in this era, at least for the states that had free banking laws, the collateral backing those notes was state bonds. The whole story here is going to be about collateral. What backs money, private money? So it turned out that those many banks failed, not because of wildcat banking, but because bond prices went down. And this is a very important paper. It's by Art Rolnick and Warren Weber, who's right here. It's a paper I always talk about, a paper I teach. And it's the first paper that shows you that this has to do with collateral. Okay? Then we move to the national banking era. Now, the national banking era, the government takes over this business. The government takes over this business, and now I come to Atlanta and I offer $10 and it's accepted for $10. So that was a huge step. However, it was not done so that we'd have a more efficient means of buying stuff. It wasn't that at all. It was that the North had no way of financing a civil war. So they decided to have this piece of legislation that would say you have to issue our stuff now and back it by U.S. Treasury bonds. So these banking panics occurred in the free banking era, but when the national banking era came into being, most people at that time thought that the whole problem with banking panics had been solved. Right? Why? Because the money is backed by U.S. Treasuries. So in 1873, there's a banking panic. And this alerts people, regulators and academics, to the fact that demand deposits, checking accounts now have this problem. Right? And it took economists about almost 100 years to understand that checks were money. Academics were writing papers like, "Are checks money?" Right? They thought it was like a savings account. They didn't realize how this was used as a medium of exchange. It's sort of surprising as you look at how the clearing system, you see millions and millions of dollars. So we're going to talk about a new form of bank money with a slightly different clientele. And it's called sale and repurchase agreements, repo for short. And I'll explain how repo works in a few minutes. And the point I want to make to you is that the idea that the form of bank money changes should not be an alien idea. Right? In capitalism, things change. That's the whole point of capitalism. Right? So things change, and if you don't keep up, you're going to be still using a landline instead of an iPhone. Right? So that kind of change happens in the financial sector as well. So let's look at the national banking era. So this is from 1865 to 1914. The rows in red are banking panics. So the column on the left gives you the National Bureau of Economic Research business cycle chronology, which has never been revised, so it's not exactly right. And then comes the date the panic started, and then is the percentage change in the currency deposit ratio. So everybody's running to their banks. They don't want their checks. They want cash. So this thing should rise until the banks all just suspend convertibility. The banks just said, we're not giving you any more money. That was always illegal, but that was never enforced. So you can see that even before they had suspension, there was pretty big increases in this currency deposit ratio. Now, during this period, the national banking era, we don't have national income accounting. We don't have unemployment statistics. And today, we can talk about this at the end if you want, we're sort of in the same world of not having the right set of measures and trying to pretend that we do. We're back in this world before you had all this information. So economic historians look at pig iron production, which was very important for railroads. And you can see from peak to trough that these panics were horrible. right? Peak to trough, this thing went down 51%. And so this was the first Great Depression. In 1893, there's another Great Depression. Then there's other Great Depressions until we get the other Great Depression. Now we call it the Great Recession. So these events were occurring regularly. Now notice a few things about this. If you look at these last two columns, this column is the losses per deposit dollar as calculated by the comptroller of the currency. So you have this horrible outcome, and yet when the dust settles, on average, 2 cents per dollar was lost in 1873. And the rest of these are just tiny. They're like the 17 basis points. Right? So what's happening is these banks are not bad banks, right? They're not bad bankers. FDR talked about this in his radio address. He said, look, bankers are not all bad. There's a few bad ones. We're going to find them. Don't worry about it. So in this era, there weren't a lot of losses, and there weren't very many failures, right? So this is sort of a hint that this event, while not irrational, is not driven by some massive problem with fundamentals. That's not what's going to happen. So this is what the banking system had looked like during that period. These are the institutions which are regulated. And so here's the bank. So the bank, the depositor deposits money in the bank. The bank says, I'll pay you 3% interest. The bank takes the money and lends it out to somebody who wants a mortgage. And this person's going to pay 6% interest. So the bank earns 6%, pays 3%, and earns the spread, right? It was a very sleepy business for a long time because this form of banking hadn't changed its basic form for about 100 years. It had been different earlier. So this traditional banking system, as we're going to see, is going to morph. It's going to morph. Now, to understand that, we need to understand a bit about bank debt and what it is that banks do. Okay, so you can't understand this unless you understand banking at some reasonable level. So the output of banks is debt, right? General Motors makes cars, McKinsey has advice. Banks make debt, right? So your checking accounts are debt, free banknotes are debt. Their output is debt, right? And then they do something on the other side with the money. Lots of firms can do what they do on the asset side. So this debt has this very particular feature. The problem is that when I come to Atlanta with my New Haven money, I don't really know what its true value is, right? I go to the store and the person in the store gets out this newspaper and they look at the newspaper and the newspaper reports a price from some secondary market where some sharp person is like picking us all off because the discount on this is only worth $9.50 in Atlanta. Is something I don't know anything about. So the whole point about banks is that they want to produce something that always trades at par but earns interest. Right? We don't want this stuff, right? It doesn't earn interest. You don't want it. Nobody wants it. Right? That's why the biggest market in the world is the foreign exchange market. Nobody wants it. It's like a hot potato. So banks want their debt to always trade at par. That means $10 buys $10. So I'm going to describe that as bank debt is designed to be information insensitive. So what does that mean? That means I don't have to, when I buy lunch with my $10, I don't want to have to worry about whether the other person knows more about the value of this note than I do. I just want to know that neither of us know anything, and so it's worth $10. And that's what deposit insurance assures you. Deposit insurance says to you, don't even worry about what it's worth, right? Just go use it. Use your checks. The government is going to take care of the banks, right? So I'm going to call that information insensitive. And then the problem is that this debt can become information sensitive. So let me show you a quick picture of that. So here's the payoff function for debt, right? So over here we have payoff on debt at maturity. So this is the face value of your debt. So it's say $100. Never mind about the interest. At maturity, you're supposed to get $100. You can never get more than $100 with debt, right? However, how much you get back depends on the value of the collateral backing this debt, right? So if the collateral is to the left of this line, then you can't get back your debt, your full amount of 100. You get back whatever the collateral's worth. This is a 45-degree line. Okay. So the idea of private money is to convince you that the value of the collateral is always over here, right? And with deposit insurance, it says don't even think about the collateral. You can just use checks. So the problem with a crisis is that if you get close to this point, right? If you get close to this point, maybe it's just here, then people start to worry about what the value of this collateral is. And when they're worried about the collateral, the best thing to do is just go get your cash, right? So if something happens to get us to this point, and people start to think about the debt and maybe produce information about the collateral, then this debt has become information sensitive. So let's talk about the collateral, right? So the collateral in the free banking era was the state bonds for the states with free banking. With checking accounts, you have diversified portfolio of loans. With repo, as I'll explain, you're going to have a specific bond. And with asset-backed commercial paper, you're going to have a portfolio of high-grade securitized bonds. Okay? So there's different kinds of collateral which are behind different kinds of money. Okay? And what's interesting, and we don't have time to talk about it, but when the bank creates money, it's always debt, but the backing collateral is always debt. Right? The same, so you really make the money information insensitive by also making the collateral information insensitive to the best of your ability. So, okay, so let's skip this. So this loss of confidence, right? So loss of, there's a lot of terms that people use, like they say, people lost confidence. That causes banking panics. People lose confidence. Like saying inflation is caused by prices going up. People die because they stop breathing, right? These are not real statements. So here, what a loss of confidence means is the debt moves from information insensitive to sensitive. And that's going to be something which happens to all bank money at the same time, right? That's not a domino effect. All bank money, right? So when Bernanke was saying 12 of 13 financial institutions are about to go down the tubes, that wasn't a contagion story. That was there's something happened which caused that to be the case. Okay, so let's move on and talk about the demand for safe assets. So I'm going to take a little sideline here. So behind these forms of money, there's some kind of collateral, okay? And there's a global demand for safe debt as collateral. So what does the State Authority for Financial Exchange in China buy? They buy trillions of dollars of US government debt, right? Why is that? Because it holds its value, right? We're selling them insurance, basically. So there's some interesting things about this collateral. So here's a picture of safe debt as a percentage of total total assets in the United States. So total assets in the United States grew exponentially in the last 30 years. More wealth was created in the last 30 years than all of human history put together prior to that. And there's two shaded areas. This is government liability. So this is U.S. Treasuries minus whatever the government's holding, like in the Social Security Fund. And this is privately produced safe debt, and I'll show you what that is in a minute. Okay? So this has been about 32% roughly since 1952. So total assets goes up, and the economy wants 32% of that to be safe assets. Okay, so that's a kind of demand for money. It's not the money you usually think of, but it's a demand for money. So there's a couple other things to notice about this that are very important. One is when the government debt goes down, the private sector fills in, right? So you can see that in the picture. You can confirm this econometrically, but the private sector wants to make safe debt if the government doesn't provide enough of it. So the private sector can't make safe debt, but they try their best to make safe debt. So this safe debt, before the financial crisis, there was a shortage of safe debt. And so the private sector started creating lots of things that are later going to get us in trouble. Now, what is the privately produced safe debt? So I'm just going to look at this stuff, and I'm going to show you the percent of each kind of debt divided by just this stuff. Okay? So here it is. So here's traditional banking. This is checking accounts. You can see that this banking system has really declined, right? It's not as important as it once was, right? And notice this happens over a fairly long period of time, right? This is not a sudden change. These other categories are the interesting ones. This category is basically money like short-term debt that companies use, sale and repurchase agreements, asset-backed commercial paper, and then you have the collateral. So this is private label, mortgage-backed securities, and non-mortgage-backed securities. So this red bar is the shadow banking system, and this blue bar is the traditional banking system. Okay? So the shadow banking system was at least as large as the traditional banking system. Right? And shadow banking is the real banking system. We need this banking system. So, in retrospect, it's kind of interesting that all this is happening while economists are writing those mathematic papers that the dean was talking about, right? I mean, this all happened like under our noses. Okay? Now, the main point here is that we're going to need this collateral, and we're going to use it to back this new form of money. So let's talk about sale and repurchase agreements. So a sale and repurchase agreement is like a checking account, basically. You deposit cash overnight, you earn interest, and you get a piece of collateral. So let's go through an example. Fidelity, one of the largest mutual fund companies on earth. People send money in, it goes into a cash account, which is going to be managed. Fidelity doesn't want this to just sit around and not earn interest. So they're going to go to a bank. They go to Goldman Sachs. They say, I want to deposit $100 million with you overnight. What's the rate? And Goldman says 3% annualized. And then Goldman says, your collateral is a bond worth $100 million, which you are going to have possession of. Not that they literally give it to you, but at the clearing bank, it changes accounts. Okay? So the next morning, every morning in the US, the repo traders call up the counterparties and they say, do you want to roll your position? That is, do you want us to just renew the loan at some new interest rate and we'll check the value of the collateral. So the market value of the collateral equals your deposit. Okay? And then you make a decision. Your Fidelity, you say, well, I need my cash or I don't need my cash. Okay? Now notice that we're talking about trillions and trillions of dollars. Right? Before the crisis, about $8 trillion worth of repo would roll. So just think about that. I call you up, I say, do you want to roll your position? If you say to me, I need my credit team to study this bond for a week, well, you don't earn interest, right? The system doesn't work that way. It's like a free bank note. We have to argue over the value of the bond. So we need collateral where that doesn't happen. So I have a lot of former students, thousands, and one of them is a head of repo trading at a very large institution. And he likens repo to speed chess, right? I mean, in the stock market, you spend a lot of time analyzing stocks, and you go to a central exchange. In fixed income markets, that doesn't work that way. And in repo, it all happens very fast. And by the way, it's not stupid. The collateral is going to be stuff we agree upon, okay? Now, so how can this work? Well, repo is carved out of the bankruptcy code. So if Goldman Sachs defaults, Fidelity just keeps the bonds, and we're done. We don't go into Chapter 11, right? So that's why it works as money. Because if we had to go into Chapter 11, our money would be tied up with lawyers and all that. So you don't do that. You unilaterally terminate and just keep the bond. So this collateral also can be rehypothecated, which is a word all economists know now. They learned these words, in 2009, collateralized debt obligation, these things. So what does that mean? So go back to my example. Fidelity has a $100 million bond. It's overnight, but they're a global firm, so they might use that bond for some other purpose. For example, they have a derivative position that's a liability for them, and their contract says they have to post $100 million to a counterparty. They can do that. So Deutsche Bank has it now. And then Deutsche Bank can use that bond to borrow in the repo market. And the next morning, if I want my cash back, I have to give them a bond. I'm Fidelity. It doesn't necessarily have to be the exact same bond, but it would have to be, say, a US Treasury. So the collateral moves around. It's like the money multiplier in simple money and banking. Okay, so by the way, we have absolutely no idea the extent of this. No idea. No data, no nothing. Okay? Now here's an important point. Let's go back to my example. I, Fidelity, deposit $100 in Goldman. I'm promised 3% interest. Now the first thing to notice is the return on the bond that I have as collateral goes to Goldman. So what is Goldman doing? Goldman is promising me 3% and earning 6%. It's banking, right? Just like the other bank, right? And what is the bond? The bond is something backed by bank loans from the other system, from the traditional system. So the traditional system's grinding out these bank loans. We put it in portfolios to make collateral, and then it's financed in this other banking system. So Goldman's earning the 6% that the bond returns and paying me 3%. So I lent them $100. The next morning, I might say, look, I'm a little nervous. I want you to give me back $2, but I'm keeping the $100 bond. Okay? So now, let's just go through this from the beginning again. This is very important. Let's start in the beginning. I deposit $100. Imagine the following. This doesn't really happen this way, but imagine the following. Goldman takes $100, they rush out, they buy a bond worth $100, and they give it to me for collateral. And they're going to earn 6% on that bond. So my loan to them financed that bond. They borrowed $100, they bought a bond, they're going to earn 6%, and they're going to pay me 3%. Now, if the next day I say, I want to keep the $100 bond, but I want $2 back, that's like I withdrew $2 because now I'm only financing 98% of the bond. So they have to come up with $2 somewhere. Okay? See the problem? So normally that's not a problem. But that's like a withdrawal from the banking system. I withdrew $2 from my deposit of $100. Okay? Okay. So we know some about this repo market. The depositors tend to be institutional investors, and a lot of them are from around the world. And so these banks need to have collateral, right? They need to have collateral. So Goldman Sachs, Lehman Brothers, all these people, the reason that their balance sheets grew is because they had to have collateral to hand out to all these people who wanted checking accounts, right? Sovereign wealth funds and so on. So these institutional investors have grown enormously in the last 30 years, right? I mean, we don't invest in the stock market. No individual household invests in the stock market. We all put our money into mutual funds and your pension fund, and the whole, trillions and trillions of dollars of financial markets are basically run by institutional investors, right? Whether it's the California State Pension Fund or BlackRock or Temasek in Singapore. These are trillions and trillions of dollars of money that are now managed by institutional investors. This wasn't true 30 years ago. Okay? So while all this wealth grew, we had along with it a number of important changes in the world. Another change, which has happened, which is a pure regulatory arbitrage, is another banking system grew up. So the regular banking system had interest rate ceilings for a long time. They couldn't pay, they only pay 0 on their checking accounts and later a little bit. So another banking system arose, money market mutual funds, where you can write checks and deposit and so on, and they don't have to hold any capital. And so they grew exponentially. All right? So this is taking money away from the traditional banking system. Now, if the I don't know what to call them, the old investment banks, if they're growing to supply this new kind of money, and commercial banks are supplying less and less money, then the total assets of dealer banks, the old investment banks, divided by total assets of commercial banks should also be growing. Okay? Remember, the economy is shifting. Demand deposits are becoming less important. All our money is run by institutional investors. They want repo. So now we have to supply repo for them. And so those institutions that do that have to grow. So I'm going to show you a plot of the ratio of total assets in dealer banks divided by total assets of commercial banks. Okay, so take JP Morgan. JP Morgan has a commercial bank. That's going to be in the denominator. And they have a dealer bank. That's going to be in the numerator. Okay, so here's what it looks like. So you can see in 1990, this ratio was about 6%, and then it just keeps growing. It just keeps growing until at the time of the crisis, it's 30%. And remember, this is around the period that these firms changed from being partnerships to publicly owned corporations, right? Which means a completely different system of risk management when you're not a partnership anymore. So, uninsured commercial banks would be financed by 75% demand deposits, roughly. Right? So they had a lot of demand deposits, even though they were uninsured and they were subject to bank runs. So it's not so surprising that the dealer banks were about 50% repo finance. And this is true since this is just one date, 2008. They started putting this information in their annual reports in 2000. And until the crisis, it was always around these numbers. So here's, total financial instruments owned, percent of that pledged as collateral. So this gives you a sense of the size of this repo market. Now remember, this is just a subset of the firms involved in this, right? We don't have any foreign firms, for example. So we have this little snapshot. So this is exactly this kind of product that they're supplying. Now, the size of the repo market, well, we have no idea. We have no idea. So at one point in the crisis, I did a back of the envelope calculation, and I said it was 10 trillion, the same size as the commercial banking system. Everybody sneered at me. And then some BIS economists did a different back of the envelope calculation, and they got 11 trillion. And then IMF economists did a different back of the envelope calculation. They also got 10 trillion. So I think we can conclude it was pretty big. It was pretty big. And it's kind of shocking that we have no other data really about it. I mean, the Fed has the repo done by the primary dealers, which are the banks that the Fed is willing to trade with. That's the old days. Now they trade with money market mutual funds. So, and also ironically, this repo was counted in this monetary aggregate M3. But M3 was discontinued in the mid 2006 because it was highly correlated with M2, right? Because they mismeasured it. So so this collateral is what I want to focus on. Now. So let's ask, what could this collateral be? What's the available collateral? So this is the amounts outstanding in the U.S. Treasuries. Mortgage related, this is all private label, but it would include home equity loans, U.S. corporate debt, agency bonds, Fannie and Freddie bonds, and non-mortgage asset-backed securities. So this is what you could use as collateral, right? Now, so that tells you what's issued, right? But one of the problems is that a lot of this is held abroad. It's held abroad. So that's kind of a plus and a minus. If you know anything about international trade, we buy teddy bears from China, we give them money, they don't buy goods from us, they buy treasury bills, right? That's a product. So our capital account looks way out of whack. We have a lot more liabilities than assets, right? We owe a lot of money to China and the oil producing countries because they buy securities, not goods. And so, but we make 200 basis points more on our assets, 2% more than on our liabilities, which tells you that we're selling a product. We're selling a product which was safe debt. So before the crisis, the U.S. had 3 industries that mattered: tech, rap, and movies and entertainment, and safe debt. That was it, those 3. Now we have 2. right? So we better hope that RAP evolves. So a lot of the collateral is off the table for purposes of use in the U.S. system, although it's not as if we don't want to have this business. We do want to have this business. So again, a back-of-the-envelope calculation says that if I subtract out the amount held by foreigners, I get 16 trillion. And what do I want to use that for? Well, we need collateral in derivatives. So when I trade a derivative with you, its market value typically is 0 at the start. And then if it becomes a liability for me, I owe you money 2 years later, I have to post collateral to you. So this organization has done a survey, and that's about 4 trillion. And we don't really know about repo, but we know it's a big number. And then there's clearing and settlement. Clearing and settlement. So clearing and settlement refers to the whole plumbing system that's behind all the financial markets. So if I buy a bond from you, I don't hold out my $6 million and you hold out your bonds and we switch. That's not how it works. It all goes through this big complicated plumbing system that nobody cares about until it doesn't work anymore, right? It's like when the sewage is backing up in your house, suddenly you want to know what's happening. So that's a huge black hole, and we have no idea how much collateral is sopped up in that. But part of Dodd-Frank is we're putting all this stuff on exchanges and we're going to be forced to have margin, so that's going to suck up a lot of collateral. The Bank for International Settlements, new bank regulations, are going to suck out about $2 trillion of treasuries. So they're pulling collateral out of the system, right? It's sort of in the name of stability. Okay, so what was the response to this? Well, U.S. commercial banks became unprofitable in the mid-'80s. In the mid-'80s, money market mutual funds had taken off, junk bonds had taken off. Traditional banking was not profitable. So a lot of things happened. I just want to focus on one thing. Securitization was the happy meeting of banks needing better financing and the rest of the world needing collateral. So a bank can finance on balance sheet or off balance sheet. The beautiful thing about securitization is that it can't go bankrupt. So let me show you how it works. So in securitization, you have a legal entity called a master trust. And this entity issues securities in the capital markets and takes the money and buys a portfolio of assets from this firm, which can be a bank, but it could also be Visa or General Motors, auto loans, all manner of firms. So what we've done is we've taken the loans that this firm has made and we've turned it into collateral that can move around to whoever needs it. Remember, in traditional banks, it's just sitting there, right? They add value by making the credit decision, right? Once the credit decision is made, they sit there and wait for the checks to come in. And if they don't, they have this division that goes and repossesses the motorcycle or whatever it is. So it's like a waste of resources. We could be using this stuff for collateral, but to use it as collateral, we got to get it from here over here. Okay? So this guy is a big fat set of rules, right? Nobody works there. It has no physical location. It doesn't do anything else. It's a robot firm, okay? And there's millions of these robot firms. So there's a whole world of these robot firms. I mean, when Enron collapsed, there was this kind of glimpse of how much of this stuff was going on. Now, they weren't securitizing, so that was a whole different ballgame. But this is a way to move passive loans that are not really being used from here to here, right? And this entity has the nice attribute that it can't go bankrupt. So there's a lot of complications here, which I'm not going to go into, but basically there was this way of creating collateral. And we needed to create collateral, remember, because we had a shortage of collateral, right? Because China's buying all the treasury bonds. So the banking system before the crisis looked like this. So over here is what the regulators knew about, right? Here's the bank, and here's the borrowers. This bank is making mortgage loans, and then the bank is shipping these mortgage loans to a wholesale bank, Goldman Sachs, that securitizes them, sells them into the capital markets to investors, and then investors might want to do repo, so they keep some of it so these guys can do repo, and then they rehypothecate the collateral. So everything to the left of that line, no one knew about. unless you were in these markets, then you knew all about it. But if you were a regulator or an academic, you didn't know anything about this. Okay? So this process of backing repo, and I haven't talked much about asset-backed commercial paper, but backing these instruments with mostly privately produced collateral from securitization was kind of a weakness. We shipped all the good stuff to the rest of the world, treasuries, and then we started using this private stuff to back our money. Okay? There's a lot more to the story, but that's basically what was happening. Okay, so that's all background. So what does this have to do with the crisis? We're supposed to be talking about the financial crisis, not teaching all of money and banking. So here's the financial crisis. So this is the amounts of subprime mortgages originated in 2005 and 2006. That's 1.2 trillion were originated. 80% of that was securitized. Okay, so these mortgages were financed by investors buying bonds. And if you bought the AAA bonds, on average, you would have lost the 20 basis points I talked about in the beginning. Now, the fact is, that if all of subprime defaulted and there was no recoveries at all, that wouldn't be a global financial crisis. That would be one hell of a problem for our country, and we still have the problem, right? Because we haven't done anything about mortgage relief. So, but that can't be the story, right? Remember the first thing I said you had to explain, the second thing I said you had to explain, the first thing you had to explain is how do you get from the loss on subprime to the entire financial system being bankrupt? And the answer is you don't need a lot of problems, right? You need some problems. So I'll tell you what this is in a minute. How many people in here have ever been to a slaughterhouse? One. Are you a vegetarian? No. So I grew up in Arizona, out in the desert kind of, and the neighbor was this huge cattle feedlot and slaughterhouse, the Tovria family. I went to school with their kids, and so one time the father took us into the slaughterhouse. And the way it works is they get all the cattle in a line, and they go through this chute, and they come to this point where they shoot a bolt through their head, and then they're picked up by the feet, and they're carried into this refrigerated room where all these guys with bloody aprons proceed to butcher this thing. And then, if they're making hamburger, they grind up the meat. And then they have to mix the meat, right? Because Americans want a certain fat content. If the McDonald's hamburger doesn't taste the same every place on earth, there's something wrong. So you have to get exactly that fat content, which means you have to mix the meat. Now, when the number of cattle that comes in is called a lot of cattle. A lot. It's not a lot, it's a lot. So it's about 30 head of cattle come in. So you make the hamburger. The next lot comes in. You do the same thing. Now, the problem is that later, somebody can come down with E. coli. E. coli. And when that happens, the FDA can go to the exact slaughterhouse and the exact lot because of that barcode. If you save the barcode on your hamburger, they know exactly which 30 cows it may have come from, but they're not sure because they mixed it, and then maybe they didn't clean their grinders, right? So they suddenly recall like 10 million pounds of hamburger because they're not sure when this all happened, because we're supposed to inspect them, but they don't have enough inspectors, they don't have enough resources, and so maybe they didn't clean the grinders, and so we recall everything, right? So I say to my students, suppose I offer you a choice of 10 glasses of fantastic burgundies, each one different, and you can pick one and drink it. But one of them's poisoned and you might die, right? So they say, oh, we don't want to do that. I say, okay, what about 100? What about 1,000? Like, how many do I have to offer you? So it's a small risk. It's a small risk, but it can generate a big response, right? So the small thing that happened was the news. The news was big for news, which was that there were problems in subprime. I mean, we didn't know at the time that the losses were going to be so minuscule, and we didn't know where this subprime was because we didn't have little barcodes. So you thought it was your counterparties. So for high-quality dealer banks, Goldman, JP Morgan, the haircuts on repo before August 2007 were zero. So remember the example we went through. I finance a $100 bond for Goldman Sachs, And the next day, I want a 20% haircut. So I want $20 back. Right? So now Goldman has to come up with $20 to finance 20% of the bond. I'm financing 80%. They have to finance 20% now. So I withdrew $20. So the question is, where are they going to get the $20? In the middle of a financial crisis, you can't issue equity, and you can't sell debt. So we'll come to that. But here's a picture of the financial crisis. Yeah, this is not government data. I had to give this data to the government. This tells you the kind of state they were in. This is an equally weighted average of the haircuts on 10 categories of asset-backed securities and mortgage-backed securities and collateralized debt obligations and some other stuff. So you can see it was 0 until this little thing where I had the heart attack, not knowing what was coming, right? And then it just rises. So here's a back of the envelope calculation. So the Fed, let's start it this way. Suppose the repo market is $10 trillion. And suppose, looking at this picture, that haircuts went up to 30% on average. So that means $3 trillion is withdrawn from the banking system. So, where do you get the money? Well, the Fed bought $2 trillion, and interestingly, $1 trillion of it basically went to hedge funds and the regular banking system, right? So that was the very, very painful process that I'll say a little bit more about. So that is related to one of the puzzles I was talking about, right? So we know now that a small shock can be a big shock in terms of news and cause this response. And let's go back to one of the pictures I showed you earlier. So what does this picture have to do with it? People are withdrawing from their repo. These banks have to come up with the money. So they sell assets. They need to raise as much money as possible. So what do they sell? They sell their best stuff. Their best stuff. And they all sell their best stuff. And their best stuff is this stuff. So every time they get a little bit riskier, haircuts go up a little bit, they dump their best stuff, but all of them dump their best stuff at the same time. They all reason the same way. So that's why the original picture wasn't the story. The interbank risk picture tracks the haircuts, and as those are going up, the banks have to sell assets, and they sell their best stuff. Now, so who withdrew from the banking system? Again, we don't have very good data, but this is from the government, Fed's flow of funds data. So this is net funding received from repo. So net means I net out all the financial firms, right? So you can see that in their data, the amount flowing in, based on what we do have, is a little over $2 trillion. Right? This is like crummy data, but it's the best we have. So you can say, well, what happened? You see this big. Here's the bank run. Right? Now, who ran? Who ran? Who was it who ran? Well, green ran. That's rest of world. Rest of world ran. And also red ran. And red is statistical discrepancy. Right? So in the Fed funds, it doesn't all add up, and so you have this thing called the statistical discrepancy, and it kind of suggests we better go find out what the hell it is, because they really ran, right? I mean, they went from about $1 trillion positive to withdrawing everything. So we don't exactly know the identity of these people. So I want to show you another picture, and then I'm going to make some concluding remarks. So I just want to stress this point about the dumping the good assets. I'm going to show you a picture of AA minus AAA spreads on 5-year industrial bonds. So let me just say that again. AA minus AAA spreads should be a positive number because AA is worse than AAA, so it should be 50 basis points minus 10 basis points, something like that. So we should see a positive number over time. And it's 5 years, so we're holding maturity constant. And these are on the run. So these are all recently issued bonds. This is data from a dealer bank. So this thing should always be positive. But nope, not always positive. Look at this. Again, what's happening? What's happening is the dealer banks are dumping their best assets. And since they don't coordinate on this, they all do it, and it just crushes the price. I mean, there was literally money lying around on the floor in the streets, and you could go pick it up. This is like a huge arbitrage opportunity, right? But nobody wanted to do it. And why was that? That's because when you have things as collateral, to have them work as collateral, privately produced, they have to have a number of properties. One thing that really helps you is very complicated. If it's very complicated, you don't have to worry about somebody producing secret information about it, right? We all know what it's worth because it doesn't pay anybody to produce information about it. So complexity is great until you're in a crisis, and then you have this and nobody wants to buy the stuff because it's too complicated and they can't understand it. So in a crisis, you're really crushed, but before the crisis, you need it to be complicated. So, throughout history, no banking system has been intentionally liquidated during a crisis. The euphemism now is resolved, which means liquidated. And banks, societies and governments have always come up with a way to save the banking system, right? They allow suspension of convertibility. They allow state governments to pass laws saying you don't have to pay your mortgage for 3 years. Supreme Court declared that constitutional on the basis of nothing. But they said it was a systemic event. So saving the banking system is something that societies have, always chosen in the brink of thing. But the problem is that saving the banking system means saving the bankers. And throughout American history, after every crisis, there's a huge anti-banker backlash and a huge, kind of narrative that doesn't make any sense that motivates some legislation which then doesn't work and we have another crisis. And the problem is that when you have this unfortunate feature that you want to save the banking system, but that means saving bankers, you put the whole, now we're all in this position where everybody wants to lynch bankers, and that doesn't lead to good outcomes. That's why I mentioned deposit insurance was a populist mandate. So the big pieces of bank legislation in the U.S., which I would count as the National Banking Act and deposit insurance, were not by intelligent design, right? It wasn't like people said, oh, this would be a great thing to have. It was finance a civil war and the American public are just demanding it. So politics basically just prevents reform. And so, we basically reproduced history very well. And unfortunately, the last crisis was, my grandmother being sent by her parents to the bank to withdraw from the account, and she got there and there was no money, and the guard gave her a painting off the wall, which I wish I still had. But that memory lasted through Jimmy Stewart and It's a Wonderful Life. So that was in the early 50s, and people still had memories of the Great Depression. And now, it's like a Family Guy had a brief reference to It's a Wonderful Life. So the whole memory and understanding of this has been lost. And on top of that, you didn't see the panic. So what did you see? You saw firms get into trouble, right? AIG didn't cause financial prices to go down. We stood there and watched them plummet, right? They just went down, right? And then the accountants, don't let me get started. So we're in an unfortunate situation. That's what I meant by a pessimistic ending. Let me stop there.
At what point should some of these complexities be illegal, or at what point should things be prevented from getting more complex on the basis that they cause these sort of? I mean, I don't think your talk necessarily said that complexity is a bad thing or a good thing, but do you think that the fact that you talk about how at the very end of all these crises, the American people go against bankers. Do you think that has something to do with the fact that they're sort of seen as these people in these high towers being able to understand these things that no other people can possibly understand?
They didn't understand it either. I mean, the complexity is not the problem. The problem is that the government had no oversight of securitization, zero. So if you have some oversight, and I have a proposal about exactly what to do, which I won't go into, I think you could see what you want. You need to have private collateral made. The Treasury is issuing bonds to fight wars and so on, not to provide collateral. So we're going to have private collateral made. What we'd like to do is make sure it's safe, but not in the sense that it's less complex, but in the sense that somebody makes some decisions about what you can use. So is if you had the system and you went to the regulators and say, can I use subprime mortgages for securitization? The answer would have been, of course, because we have a national policy that everybody should have a house. Subprime before the crisis was this huge thing that was great. But if you have these institutions in a framework where they have access to a discount window and so on, then you can make this system work. So I just want to point out that this is a free enterprise system, right? You can't make banks do things because they can always exit. They can go make widgets. So you have to have a carrot and a stick. You can't just have a stick. Because the shadow banking system that we see 20 or 30 years from now is going to be something they didn't notice either, and they didn't know why it happened. And so it's very important to bring this stuff into the umbrella rather than push it out. So let me give you another example. The Volcker rule had nothing to do with the crisis. Even Volcker says that. It has nothing to do with the crisis. So, think about the Volcker rule. Would you rather have the risk being taken in an institution that you oversee, or do you want to push the risk somewhere where you don't even know where it is? Right? I mean, it's that sense in which you need more oversight, but that doesn't mean you prevent things or these kind of policies.
By oversight, then are you also referring to more information? I mean, you mentioned that regulators didn't know what was going on, and economists didn't know what was going on. Was that lack of information?
No. I mean, it was and it wasn't. I mean, remember that there's two kinds of markets, right? There's very information-sensitive markets called stock markets. Those trade in central locations where everybody can see the prices. There's zillions of equity analysts, and the University of Chicago has been studying it forever. Okay? Then there's another sort of market that's much, much bigger, but it doesn't trade in a centralized way. It trades over the counter. And why does it trade over the counter? Because there's no information to produce anyway. It doesn't even matter. Right? I mean, most of these bonds are sold and they never see the light of day again. They mature and so on. So it's a market that functions because it's information insensitive. So that's that world we need. Right? So if you, again, think about deposit insurance. Deposit insurance didn't say we don't want any information. It said we want the government to get the information. And examination reports of the government are confidential. Even now, they're not even released 50 years later, right, Mark? Mark's trying to get them. So this is the better solution. I mean, let me put it to you another way. Suppose you lost electricity power in Atlanta. Okay, so there's two things you could do. You could respond by saying we need transparency. We want all these blueprints put on the web so I can understand the electrical system. Or you can say, I never want to know anything about electricity. I don't even know what electricity is. I just want to have somebody who doesn't let this happen, and I'm going to worry about that, right? That's the way these systems should work. Now, why didn't we know about it? Well, I think this goes back to this question of where we get our information, right? So in the Great Depression, Roosevelt sent people out to count freight cars to try to figure out whether the economy growth was going up or down. So in a world like this world, where you have derivatives and off-balance sheet stuff, you need a measurement system that can measure risk. So in the Great Depression, Roosevelt realized this was a big problem, and he put a lot of resources behind national income accounting. And Simon Kuznets, who got the Nobel Prize for this in the US, another person got it in the UK for it, worked with the government. It was part of the government. And it wouldn't have really succeeded finally until, but by good luck, we had World War II. And then the government wanted to know, they had questions like, if I stop the auto factories from producing cars and I make them produce tanks, what's going to happen, right? So that push got us national income accounting, which is probably the biggest achievement of economics, to actually measure economic activity. Now all our measurement systems are cash-based. Accounting, Fed funds, national income accounting, but this world doesn't work that way, right? So, I have a proposal about measurement, but the momentum on this has been lost already. It's not going to happen. We need about 6 more crises. That'd be good for research too. But I'll tell you, for academic economists, I mean, I spent 30 years on financial crises, even though the rest of the profession said I was an idiot and told me I was working on irrelevant stuff, right? And why did I plug away? Well, it's not that I knew there was going to be a financial crisis. I just knew the financial system was important, right? The rest of the world, doesn't think that. Most, macro models or asset pricing models, they don't have banking systems in the model. They think it's all irrelevant, right? So they've been exposed as frauds.
When you see global growth occurring really in kind of the peripheral countries, regions,
Yeah.
do you see that growth as they start to grow up, need financing needs to do so, that growth is tied to systemic events in the U.S., and so that correlation effect or the kind of crises occurring in the U.S. will start to really affect these global countries more, especially like frontier markets, emerging markets?
So that's a really complicated question. I don't know the answer. I mean, let me just tell you one fact that I think is kind of interesting. I was talking before about, we buy a teddy bear from China and they buy a treasury bond. So these accounts, these foreign trade accounts net. So, you net your assets and liabilities and you see whether it's zero or not. And, that was done because it was always, pretty close to zero, and if it wasn't close, it was going to, become close over time. But what people have noticed, some people, a small number of people have noticed that if you look at the gross flows in the capital account, so this is financial transactions, the U.S. with the rest of the world, the gross flows are unbelievably large, like orders of magnitude, bigger than they used to be. And they're disconnected from the current account, which is the goods. So it used to be you got international financing when you did exporting and importing, and that would drive the capital account if they didn't buy goods. I sold goods, they didn't buy goods, it went into the capital account. But now the capital flows are so enormous that they're disconnected from the current account. And that's an important hint. I think that's a very important hint that the financial system is just, it's global. It's global. And, it's very, very difficult to coordinate with other regulators and, other central banks. I mean, a lot of that was done during the crisis, but you can imagine this stuff moving somewhere. We don't know where. I mean, take the Volcker rule. There's a demand for risk. There's lots of investors who want risk. It's not irresponsible risk. They want high expected returns, and they're willing to take, high volatility. So that's a product. How do you supply risk to people, to firms? So, somebody is going to view that as a profit opportunity. Hedge funds can't do it. Hedge funds are small, relatively speaking. So somewhere on earth, somebody's going to come up with a way to sell risk. So we're not going to know where that is, and I suspect that it may not even be in the United States. We'll find out in the next one.
Speaking of risk, you had some connection or affiliation with AIG back at the time of the crisis, and they were widely reported to be involved with huge amounts of CDSs, credit default swaps, on these subprime mortgage tranches and so forth. The people at AIG were very intelligent, very careful people. Did anybody see the freight train coming that was going to hit them?
So let me first point out that the government, the Fed, made $30 billion profit off our positions, right? So, the fire sale prices caused us to have to put out collateral. But once the dust settled and the prices came back, the Fed made $30 billion. So AIG was the world's largest insurance company, and the asset management arm, we were a kind of a separate subsidiary, AIG Financial Products. The asset management arm lost real money. So when they appointed a person, a vice chairman of Morgan Stanley, to come into AIG Financial Products and to run it, And he told me later he thought he was going to come in and there was a bunch of cowboys and they didn't know what they were doing, and he was totally shocked, right? And I can tell you, I've never been around a smarter set of people in my life. They're smarter than people at Yale, right? They're smart. They're goddamn smart. You know, they don't have time to really think about stuff like we do in academia, but they're smart. And the thing about AIG is that, you know, again, there was a whole combination of problems, right? Remember, Eliot Spitzer kicked out Hank Greenberg, who's a kind of business genius, right? And so Greenberg was gone, and we got this guy who just didn't know what he was doing, and he did all the wrong things. And, you know, so it was you know, when I look back, the two biggest risks when I was there, the two I never would have dreamed of, it's management and accounting. Right? Those were the risks. And, you know, you can't control Eliot Spitzer kicking out the CEO, and you can't control the accountants, and they do insane things. So, you know, I mean, you know, people said, why don't you write something about AIG Financial Products? And the answer is, I think it's a sideshow. It's not central to anything that happened in the crisis. And the press, you know, they're never going to get it right because the people who know aren't going to talk, and the people who talk don't know. And, you know, it's just not, I mean, the press is a really interesting, you know, phenomenon. I mean, you know, the press is didn't really do a very good job, but it's really hard to blame them, right? They'd call up economists, and economists had no idea. If you call the experts, and the experts don't know, how are you supposed to know, right? And Congress, you know, these people have 9 million things they have to be experts on. They can't be experts on everything. So, you know, in a lot of ways, it really was a failure of the economics profession to kind of explain things coherently in a way that the public could understand and would lead to good policy. That's why, you know, Roosevelt came into office. Inauguration was in March in those days. First thing he did was give a radio address about banking. And the next day, people lined up to put their money back in the bank. Right? Roosevelt explained what had happened and what the government was going to do about it. And, you know, this crisis wasn't like that. I don't know how many times I yelled at Ben Bernanke that he had to articulate a narrative. You have to tell people what's happening. You know, we can't get Obama to do it. Obama should have done it, right? Like on the first anniversary of Lehman or something like that. He should have explained to people what was going on, right? But he had to run out in front of the pitchfork crowd. So it's, you know, and that's what I mean about when you save the banking system, you save the bankers, and you don't get anything right. Now, Roosevelt didn't have the luxury of really doing that because the public wanted deposit insurance, right? That was, you know, they weren't after bankers. They wanted deposit insurance, and that's how we got deposit insurance.
One more question.
So you're kind of talking about the moral crisis of saving the bankers. First, do you have a solution for a bailout plan that doesn't have that moral crisis? And the second one, maybe more at home for all of us, is where do you have your retirement money?
It's in TIA CREF. So let me answer the first question. And that's a really good question because it hasn't been the focus of legislation. It seems to me the best thing to do is to not have a crisis, right? That's what we should do. We should not have a crisis. We shouldn't be worrying about how we're going to liquidate all the banks when the next crisis happens. We shouldn't even have a crisis. And we know that's possible because from 1934 to 2007, we didn't have a crisis. Canada doesn't have crises. So why can't we have a policy where you don't have crises? But you're right. The whole focus has been on what are we going to do when there's the next crisis, right? So they're kind of trying to prepare for the next crisis. And crises, if you really know how they're going to happen, they're not going to happen, right? They happen. You never know what's going to happen, right? So they're going to plan for all this stuff, and I can tell you, none of it's going to work. Crises happen so fast. They're so chaotic. You know, if you read the minutes of 2008 of the FOMC, they had no idea what was going on. They literally, and it wasn't only them, but they're in these meetings, and it was clueless. They were clueless, So it'd be better not to have a crisis. But the problem is, so Tim Geithner told me two interesting things. One was he said, my job during the crisis was to do one thing and one thing only. I had to wait till the crisis got bad enough that I could get a consensus to get a lot of money out of Congress, but not so bad that when they gave me a lot of money, it was too late, right? You know, okay, that's conditional on having a crisis, right? So, you know, you can see the problem. Now, the other thing was that Dodd-Frank was rushed through before the Financial Crisis Inquiry Commission had even finished anything. And, you know, it was kind of a hodgepodge of people's private agendas and some kind of stuff that, you know, various constituencies wanted, right? I mean, there's people down there who are like running for office. I won't name all their, you know their names. And so it was this sort of grab bag of things. And that's pretty much like every financial crisis in the U.S. And that's why I think this point about, you know, you save the bankers, the blowback from that is why we only got the National Banking Act because of the Civil War, and we only got deposit insurance because the American people rose up. But to your other question, I mean, you know, bankers may be greedy, and the rating agencies, you know, all this stuff. You can make a big list of stuff, right? And you can tell from if you think these crises all have something in common, then we know it really doesn't have anything to do with the rating agencies. If banker greed causes crises, we'd have one every week. I mean, you know, it's not, these things are the kind of populist stuff that gets us driving off the road, right? That's not to say that there's not problems with all this stuff. I think you can make a list of 25 things, and maybe there's problems with all 25, but at the top of the list should be stop crises.
Well, thank you so much.
Thank you.
The preceding program is copyrighted by Emory University.